Welcome to Markets Now. I'm Michelle Rick along with Kent Beadle with Paradigm Futures. We're seeing a lot of lower prices in grain and livestock futures trade this morning, with the exception of the wheat market. And, like I said, a lot of red on the board, Kent. It feels like kind of a risk-off day. Where's that coming from?
Well, I think it's coming from the equity markets and the interest rate markets. We are making new highs in interest rates once again. We've taken the 10-year up above 4.7%. That's a new high for the move. The U.S. dollar is making a new high for the move, now up over 107. These are the strongest levels for the U.S. dollar in well over a year. And the marketplace just feels as if it's getting concerned about the impact that these higher interest rates are going to ultimately have on the consumer. So you see the most initial impact over in cattle, where very high priced livestock is starting to get concerned about whether or not the consumer is going to be able to afford beef. You're seeing that spill over a little bit into hogs as well. And with lower livestock, you see the corn market coming down a little bit, even though it did have a bullish report last week, and it did trade very well yesterday in the midst of, or the aftermath of the sell-off that we had on Friday.
Yeah. Soybeans, though, obviously have made some new lows for the move here. And basically, we're seeing harvest pressure. Is that kind of overcoming some of the positive demand news that we had this morning in that China business?
Yeah, well, the China business is fairly routine. We're going to sell the Chinese soybeans just about every single day. We're going to report it every day that total is up above 100,000 tons. And but we're going to sell them beans. But that was a routine number. I think what the market is concerned about is the Brazilian harvest progress picking up a little bit. There's still a little bit of worries about being too wet in the south, but we've been noticing that the monsoonal rains in Mato Grosso have maybe been a little bit better than advertised, and the pace of planting is probably picking up. And so, right now there doesn't seem to be a lot of concern about the Brazilian crop. And at this point, the markets continue to want to look ahead to that large crop that's coming at us. And, of course, our decline in exports year over year, and it's just making soybeans very difficult to maintain much of a higher price structure that we've seen previously.
Yeah. Plus, meal is down pretty hard today, and we should talk about the fact that crush margins have kind of, eased. Is that the right word?
Yeah. Off, 30 to as many as 40 cents a bushel off of recent highs. They're still actually quite profitable as you think about the nearby part of the curve. As you work into that time frame where South American supply is going to be more available, that being in that May, June, July type time frame, the crush margins out there actually have shrunk up to under $1, which is it's still profitable historically, but it's so much less than what the industry had been seeing previously that it's a little bit concerning. And of course we did see yesterday that our final crush number ended up being a little bit below expectations as well. And so that I think was weighing on beans a little bit today also.
Mm-hmm. So the corn market, is it just getting drugged down by soybeans and meal here today? And do you think, have we put a harvest low in, because that market has held up really well here, considering how big of an ending stocks number we're staring at?
Yeah, well, of course, we, as it turned out, we didn't have as large an ending stocks number as last year.
Right.
But that has helped us recover a little bit. The reason I think that we're finding more support in corn, and why I think it's very possible that we have made a harvest low, is just the margin that we see in the usage of corn. Now, if we were to continue to see livestock prices to pull lower, if we were to turn, say, gasoline prices around lower, then it might be a little bit harder for corn to hold up. But there is margin in ethanol, in fact, very, very good margin in ethanol right now. And there has been a very good margin in cattle and hogs as well, especially as you project hogs out into the summer months. And we had a good recovery in hog margins off of the spring lows where we had a lot of red ink in the industry. And so I just think corn prices had dropped into an area that represented pretty good value for most end users in the United States and in many cases around the world.
Wheat market is to the plus side, at least Chicago right now. And of course, that's tied to over 8 million bushels of China SRW business here. Have we finally gotten prices low enough we're competitive?
It feels that way. And I think that the sale to the Chinese was a surprise to the market. It's very possible with the rally that we had yesterday that the commercials involved in the tender probably knew that this was coming, because we had a very, very strong day in wheat yesterday, obviously. But getting some follow through probably tells me that the rest of the trade was a little bit surprised by it. Now, for us to be able to have a sustained rally in wheat, it would probably be worthwhile for us to maybe book a few more of these sales. But it does tell the world that we are now competitive, especially if we don't run away to the upside here again. But if we maintain soft red wheat between this $5.50, $6 a bushel area, we're probably going to be able to connect on some additional business.
Well, let's hope it's that and not just correcting our oversold status after these lows that we scored here recently. So, Kent, you mentioned the cattle market seeing some press here because of the risk off with the stock market being down. Talk about support. Have we taken out and violated support that we, are worried about that it's going to turn the market over or get some of these funds to liquidate?
Well, today we did take out some recent lows in that 187.50 area that had been lows over the last 3 or 4 sessions that we were consolidating. We've done that a number of times on this rally, and you end up posting what look like bear or bull flags on the chart. You go up and then you consolidate, but then you ultimately break through to the upside. Today we're breaking through to the downside. And as we look for that next level of support, it's actually down in that much broader consolidation that we had from July all the way through September. And that area is about $182. So we're still about $4 away from that next level of support. Having broken through that bull flag looking chart pattern and having fallen further, we shouldn't be surprised if we do drop another $3 or $4 down to that major support at $182 against the D-slot cattle.
Yeah, it did look like we took out enough support to get some sell stops tripped here this morning. Cash trade is going to be pretty key. It was a little bit weaker on the weighted average last week. Are you thinking we'll see the same tendency this week or not with the new formula supplies coming to the market?
Yeah, it's very possible that we're going to be, the calls that I'm hearing for cash this week have been steady to weaker. And I'm anticipating maybe down $1 again. Ultimately, I've been waiting for an awful long time for a more significant washout in cattle. And, we do have a very large, long speculative position. I'm not convinced that the underlying fundamentals ultimately have turned to be more bearish. Again, that's going to be probably determined by the consumer and whether or not they start to get heartburn with these higher cash beef prices at the grocer.
And hogs, more pressure. Are we still getting a hangover from the hogs and pigs report? And where do we have to find support here?
Yeah, I think we would be anticipating that we might be able to make some new lows in the hogs ultimately. We just have more supply than we thought we were going to over the course of the last number of months. We seen very low isoine prices. We've seen some sow slaughter that we thought was going to determine a smaller pig crop and smaller inventories on this last hogs and pigs report. And the productivity here this past summer was just phenomenal. And ultimately, that was the major reason why we didn't see that. And so we do have higher hog supplies in a period where we typically tend to move lower at this time of the year. We think that new lows are probably ahead of us in the hog market.
Okay. Thanks for that analysis. As always, Kent Beadle with Paradigm Futures. That is Markets Now.